Hello friends, my name is Dheeraj Vaidya from wallstreetmojo.com. This is the part 25 of our ratio analysis video series, and in this installment we learn all about the operating leverage. In simple terms, operating leverage can be defined as the capability of the firm to use its fixed expense to basically generate higher return. So in this tutorial we discuss again the four things. 1. Understand what operating leverage actually means. Number 2, its formulas and calculations. Number 3, we'll apply those calculations on Colgate. And number 4, its interpretations and uses. But before we jump into the tutorial, a quick reminder. We will be needing all the working files of Colgate Case Study for this video. So if you haven't downloaded it yet, please do so from the link in the description box below. And to keep yourself updated with investment banking and financial modeling concepts, please do subscribe to our channel, Wall Street Mojo. So let's get started. What is operating leverage? Operating leverage is a part of the ratio analysis framework and it comes under the business risk category. Operating leverage primarily tells us, how the company is utilizing its fixed assets to generate higher operating profit. If you remember from our earlier videos, you might know that operating profit is basically the earnings before interest and taxes. So that's what we are talking about. What does fixed cost has to do here in this context? What essentially it means is that, let's say if there is a company that has invested heavily in its asset, those assets in order to break even will have to generate higher amount of sales, right? But for those companies which have invested in assets and better technology, for them, the variable costs will be very low, but the break-even point will be very high. On the other hand, if there's another set of companies like, services companies like Accenture, Cognizant, where, the fixed cost is very low, but the variable cost is very high because you require lots of people to work on various projects, right? In that context, the break-even cost will be low, but at the end of the day, the operating profit will not move faster because of the higher variable cost. So operating leverage basically tells us how this actually works. I guess if it is a bit confusing, let me do one thing. I'll introduce you to one example and you might be able to kind of appreciate what that fixed cost has to do with the break-even point and how does it move the EBIT. So let's do one thing. Let's take an example. We'll take an example of two companies, company A and company B. They operate in the same sector altogether. Okay. So let's say the first one is higher fixed cost and low variable cost. Now, what do you mean by higher fixed cost and low variable cost? Obviously, when you are investing in technology, the variable costs, like let's say the amount of labor that you require and the way you process things, the cost associated with that will be relatively low because you've invested in the technology part of it. And on the other side, there could be like, companies who have not invested in fixed cost, but because they haven't invested in technology, they might require higher number of laborers, more number of laborers, more raw materials, slippage cost will be higher. So all of these things lead to higher variable cost. Okay, so this is the two types of company A and this is company B. Okay, so we'll take a numerical example to finally understand the meaning of operating leverage. Let's say both the companies will be similar in the context of almost everything in terms of the number of sales unit, average selling price and everything. The only two variables that will change is the fixed cost and the variable cost. All right. Let's assume that the total number of sales unit that are sold by company A is 18,000 and the price per unit is $50. Variable cost per unit. So since this is a high fixed cost and the low variable cost, let's keep the variable cost per unit as $5 per unit. Fixed cost, let's keep it at 500,000. And the last item that will come here is the SG&A expense, that is the selling, general and admin expense. That will be similar for both the companies, company A as well as for company B. So let's keep this at 100,000. Okay. So these are the numbers for company A. I'll copy these numbers here and make the relevant changes for company B. Okay, the relevant changes for company B will be here, assuming that the sales unit and price per unit is same because we want to compare the two, right? The variable cost will be higher in this company B case because the fixed cost is low. So let's assume this is $10 per unit, and the fixed cost here, let's assume it is 100,000. Okay, so these are the two set of financials. So let's make an income statement for company A and B until the EBIT or the operating profit. So let's look at how this is like. So sales, this will be price per unit multiplied by the total number of units sold. That is 900,000 is what we'll get, right? That is sales. Cost of goods sold will be the variable cost per unit multiplied by the total number of units. Okay, so we'll get the gross profit. This is equal to 900,000 minus 90,000. So that comes out to be 810,000. Okay, that is the gross profit. Now next comes the selling, general and admin expense. That is we have it as 100,000. And another item that will come because we have taken the fixed cost into our books. So that's the depreciation expense. So let's assume that the depreciation expense is calculated in a similar way for both company A and company B. So let's assume that the depreciation is on the straight line basis, and the asset that company A and B, both of them bought, will have a useful life of say 5 years. Okay. So how do we calculate the depreciation? The depreciation will be easy. 500,000 divided by 5, right? So we get this as the depreciation for company A. So what is the EBIT or the operating profit? This will be gross profit minus your SG&A expense minus your depreciation expense. So that comes out to be 610,000. Okay. So I'll copy this set of formulas for company B and we'll get the data, the EBIT data for company B as well. So here I have copied this, and as we can see here, what we get in terms of operating profit for company B is slightly lower, that is at $600,000. One important thing to note here is that at 18,000 as the sales unit, more or less the profit for both the companies is similar. But let's say what will be the break-even point, right? Because this has a higher fixed cost and a lower variable cost, and this has a lower fixed cost and higher variable cost. I'll just change these numbers. Let's say if it was 5,000. Okay, so this is operating profit is 25,000. Let me make this as 4500. Yeah, so still lower than 4504,400. Okay, so it goes negative. Maybe between 4400 and 4500 units is its break-even number. Let me make it as 4450. Yes, let's consider this as the break-even point for company A. Let's see how much is the break-even point for company B. So if I keep this as 4450, how much will that be? The company seems to be profitable at 4450. Let's make it at 4,000. It's still profitable. 3500, still profitable. 3,000. Okay, so here it seems like 3,000 is the break-even point for company B. It is obvious that since company B has a lower fixed cost, the break-even point for them is slightly lower. So it's at 3,000. But company A, which is operating at a higher fixed cost, has a higher break-even point. So now that you have an intuitive understanding of what operating leverage means and how it affects the operating profit, let's try and quantify this. Its quantification is done using this formula called as degree of operating leverage. So what does this degree of operating leverage does? It basically tells us, it tries to see how sensitive your earnings before interest and taxes is, that is the operating profit, as compared to your percentage change in sales. So as we saw here, between sales and EBIT, this fixed cost has been taken care of by the way of depreciation. That's what the sensitivity is all about. It tries to calculate the sensitivity of sales and it sees the sensitivity of EBIT and tries to find a ratio of the two. So that's termed as degree of operating leverage. So let's make these sales units back to 18,000 for calculation of degree of operating leverage. So here we will have percentage change in EBIT, and we have percentage change in sales, and the ratio will be called as degree of operating leverage. Okay, so obviously to calculate the percentage change in EBIT, we'll require the EBIT data for 2 years. Let's assume that this was the first year, and in the second year, so instead of 18,000, let's say they managed to do 20,000. All right, so the EBIT will change accordingly. The same goes with company B as well. So I'll make this as 18,000 as it was earlier, and let me just copy this and make the data here as 20,000. Okay, so we'll calculate the degree of operating leverage for both company A and company B. So how much is the percentage change in EBIT for company A? This is the way you calculate percentage changes in Excel, is that you take this cell divided by the change, like 700,000 divided by 610, and put a -1 sign. Okay, so that's how you calculate the percentage change. So percentage change in EBIT comes out to be 14.75%, and percentage change in sales is this divided by this -1. So it's 11.11%. So degree of operating leverage is the ratio of the two, right? So let me calculate it. 14.75 divided by 11.11% comes out to be, if it is a ratio, let me put it in the ratio format, it is 1.328. Okay, let me now copy this for company B as well. For company B, it comes out to be 1.20. If you look at these two ratios, you can probably identify, the reasons behind higher operating leverage and lower operating leverage. Companies which have a very high capital structure, as in terms of high capital intensive companies, they have a higher operating leverage. Like in this case, this is a high fixed cost company, so it has a higher degree of operating leverage. Companies which are low fixed cost companies, like services companies I was talking about earlier, they have a low degree of operating leverage. So this essentially means that the EBIT, or the operating profit, here in this case is not that sensitive as compared to the ones which have a higher fixed cost structure on its balance sheet. Okay, so this is how you basically interpret operating leverage, and the quantification of operating leverage is done using this degree of operating leverage formula. Now let's calculate the degree of operating leverage for Colgate. So here is the income statement of Colgate, and we'll now find out the degree of operating leverage for Colgate. For doing that, let me scroll down to this row number. Yeah, row number 81. Okay, so this is the operating leverage, and this is where we will calculate the ratio. Now, for doing that, we require the percentage change in sales and percentage change in operating profit, or EBIT. I've given the space here. Basically, here we will calculate the two things: percentage change in sales and percentage change in operating profit. And finally, we will calculate the operating leverage here. All right, so let's do that. How do we calculate percentage change in sales? That's fairly simple, as we discussed earlier. This is the sales items. So this is 2017 data divided by 2016 data -1. So once we do that, we get the percentage change in sales. Okay, so let's copy this across until 2020. Okay, so we see that the sales has grown, though a bit slowly in the 2018 and 19, but it grew by 5% in 2020. So this is the sales growth data that we have. The next thing we require for calculating operating leverage is the operating profit growth. We won't be able to interpret much here as such, but as far as the interpretations goes, we have learned that it tells us about how much amount of fixed assets are there in the company and how it affects the operating profit as far as this goes. I hope you found this video to be useful. Please do like and share. And if you have any feedback or want to suggest a topic for any future video, then you may do so by writing about it in the comments section below. And we come up with very interesting videos on investment banking and core finance topics regularly. So if you haven't subscribed to our channel yet, please do so by clicking on the subscribe button below so that you can get the notifications about our latest videos as soon as we release them. So I hope you enjoyed the video. Have a nice day.